Now, Anthony, since you were last on CNBC, the Fed, of course, boosted rates by 75 basis points. What does that latest move do to your business?
In periods of uncertainty and volatility, the need for financial services goes up. And so for those viewers, SoFi has three different segments of its business. We have a lending business, unsecured personal loans, mortgages, student loans. We also have a technology platform. We enable many of the fintech companies to provide payment activity. And then we have credit cards, checking and savings, and investing. And in a higher rate environment, we're seeing really strong demand in unsecured personal loans. We're also offering 1.5% interest rate on our checking account, which is pretty much unmatched. So those businesses definitely benefit from that environment. And investing is something that we recommend to our members that they do it throughout time through dollar cost averaging. So the demand for financial services products in this environment increases.
But in an environment which is incredibly volatile, I mean, we've been talking this morning about the big swings that we've seen in the stock market. How is that impacting the behavior, not just of investing, but also of trading, how your customers are seeing their opportunities right now?
Yeah,
or the risks, I should say.
Absolutely. We really have to stick to our discipline. Even though the demand is up, we have to stick to the fundamental approach that we have in lending. We only lend to a high-end consumer. $160,000 of household income is our average income for a borrower with a 740 FICO score. So we're watching that area really closely. On investing, we're encouraging our investors to be diversified. One of the reasons we offer stocks and fractional shares and ETFs and robo is so that they can diversify their holdings and navigate through a volatile environment like this.
So with that window into the American consumer, what are you seeing right now? I know this is a question on the mind not only of our viewers, but of all the CEOs here in Sun Valley.
It absolutely is. And our guidance back when we reported in May called for 50% year-over-year growth in revenue from $1 billion in 2021 to $1.5 billion and above that in 2022. And we are thriving in this environment, both because we're taking share from traditional banks, in addition to the fact that our members are doing more and more with us every day.
I mean, look, I know your earnings are coming up in a month, so you can't give us too much insight into what's going on in terms of your financials, but give us some insight into the state of the consumer, of your consumers. Has their behavior changed in the past couple of months since your earnings, in the past month, as we've seen so much pressure on the market?
I'd say the demand for our products has stayed really consistent. And once people use our products, whether they're investing or they're spending with a credit card or spending through their checking savings account, it's remained consistent with what we've seen in the past. And the most important thing for us is to make sure we don't overextend ourselves in any way to capture too much of that demand. So we're looking at a vast amount of economic data to make sure that we're still green across the board.
But is it the fact that the demand that you're seeing from consumers is consistent, does that say something more about your consumers who happen to be these more affluent consumers? Or do you think this could be extrapolated more broadly in terms of the way Americans as a whole are spending and saving right now?
We do have a higher end consumer, more of a mass affluent consumer. And so you really have to look at the low end. I think it would be naive to think higher gas prices is not affecting the basket size, the spending on categories of a lower end consumer. So we're watching that very closely. That will be the first person that's hit, and then it will cascade up through the spectrum of economic of demographics.
Another factor that's going to impact your consumers is what President Biden does in terms of whether or not he cancels more student debt. What are you anticipating there, and what would the ripple effect be on your business?
Yeah, there's sort of two elements to the student loan situation. You know, we're very fortunate in that we've built a diversified business, and our student loan refinancing business has been operating at less than 50% of where it was pre-COVID, and we've still hit in record quarters and are growing 50%. I think he'll stick to his campaign promise, which is to forgive $10,000 of student loan debt for those that are in need. That won't really have an impact on us negatively. It actually have an impact positively, because it will give consumers that have student loan debt certainty that they should refinance now when rates are low. They've already missed a 200-point move, unfortunately. I think the advisors to the president are not helping him. The stimulus that they're providing through student loan moratorium is $5 billion a month. It's $130 billion over the last 2.5 years. That's throwing fuel on the fire of inflation. And this is when we should be helping people lower their debt and lower their cost of debt. But instead, because they haven't taken action, we're not helping the American people. So number one is end the moratorium and give certainty on forgiveness so the American consumer can make a decision on their debt and lower it for the long term.